Let me summarize our discussion of income taxes. First, there's the notion of the tax bracket. Income is taxed in chunks. The first part of income in almost every tax system around the world is not taxed at all. So that's a 0% tax bracket. And your income after that is chopped up into pieces. This piece is taxed at one rate. The more money you make, the higher different pieces are taxed, the higher rate. So that's the notion of the tax bracket. And the important thing to remember is this. Income in the low tax brackets is never taxed at a higher rate ever. In our simple system, that first $50 is never taxed at anything other than a 0% tax rate. Same thing in the United States. The income that's excluded from taxation under your personal exemptions and the standard deduction is never taxed. It's in a 0% tax bracket. So don't be afraid of making more money and going up in the next tax bracket because that first amount of income is never taxed at higher rates. We also discussed the notions of the average tax rate and the marginal tax rate. The average tax rate, how much tax do you pay divided by how much do you make? Average tax rate in the United States for individuals, somewhere between 17 and 20%, depending on who you are. But that's the average for everybody across the United States. Marginal tax rates, on the other hand, that's the rate that you're going to pay on the next dollar that you make. And economists say that that marginal rate is a very important rate because that's the rate that people have in mind as they consider, should I work harder and make more money because it's that marginal rate that I'm going to have to pay. We saw the difference between a tax deduction and a tax credit. A tax deduction, if you spend money on a tax-deductible item, you don't have to pay tax on that particular item. So we saw it in our example. If you have a $10 tax deduction, that's actually going to save you $5 in income taxes. So the government says, thank you for spending your money in that way. You don't have to pay tax on that money. A tax credit, on the other hand, is so favored by the government that the government will say, if you spend $10 in a certain way, that's the same as our spending that $10. You just keep that money. You don't have to pay any tax at all. If you have a $10 tax credit, your taxes go down by the whole $10. A tax credit is more valuable to you in a tax sense than a tax deduction. We discussed the difference between ordinary income and capital gains income. The most important thing from a tax standpoint is capital gains income is taxed at a lower rate. Ordinary income is most of the income with which you and I are familiar. Wages, salaries, interest on savings accounts, and so forth. Capital gains income, if you invest in a stock portfolio and it goes up, the increased amount is called capital gains income, and you typically pay a lower income tax rate on capital gains. Therefore, many tax shelters are designed to classify income not as ordinary income, but as capital gains income. Overriding everything with respect to income taxes is this. There are precise rules set down by the government where you live, and your objective in income tax accounting is following those rules so that you comply with the law. You want to pay all the tax that you owe. It's certainly a legitimate thing to plan your affairs to pay the minimum tax allowable under the law, but you want to make sure that you obey the rules and pay the tax that you owe.